What a day on the stock markets today. Now, the stock markets, of course, have been on a bull run, have been on an upswing for some time today. But the kind of rally we saw in the markets just after the Fed meet yesterday, which showed that the time was ripe for tapering down, although Jerome Powell did say that interest rates are not going to go up anytime soon, shows that there is something else pushing these markets. Yes, there are so many factors. The Evergrande fear is receding, and that picked up the global markets yesterday as well. But India, if you look at it from a broader point of view, Indian equity is seeing a watershed moment, and a lot of it perhaps is being pushed by retail investors. Let's go across first to Managing Editor of ET Now, Nikunj Dalmia, for his take on what we're seeing in the markets today.
For me, I take a lot of heart in the fact that the index is, or the Sensex is nearing 60K. But in this bull market, for the first time, you could say that apart from Indian promoters and global investors, Indian investors, A, they've participated, B, they've created wealth, and C, they've kept their belief. And it's very heartening to see that at a broad level, an asset allocation change is happening. Indians have been known for buying into gold or investing only in real estate. Indian stock market periodically saw their bouts of volatility, and they were going through a transition process, because every 6-7 years either you would see a big global market crash or you would see a local scam. I think this decade, barring the 2008 financial crisis and barring few odd patches in the last 10 years, the markets in general have been rewarding for long-term investors. And we are staring at a very different kind of an India, where the number of new DMAT accounts which are opening, where the new number of interests which people are taking at a mutual fund level, or even at a portfolio level, even at a PMS level, I think that is increasing. I guess there is a new breed of investors which has come in, and that new breed of investors now has a full belief in some of the Indian promoters. So for me, this is a message, and this is a trend. And this hopefully should be a multi-year trend where we see a big asset allocation change, at least in Indian equities. See, equities for the better part of last 20 years have not really enjoyed that kind of a appeal with Indian investors. And I think the fact that you got a SIP book now, which runs into 8,000 to 9,000 crores, roughly about $1.5 to $1.4 billion on a monthly basis, it's quite incredible. So gone are those days where foreigners would catch a flu and Indian markets would freeze. Gone are those days. Indian markets are no longer a one-trick pony, and I think the evidence of that was there in the month of July and August, when FIs were selling and Indian markets, courtesy local flows, were still moving higher. Now we can get into this near-term valuation concern about the run-up has been strong, the market is a bit complacent, a correction is round the corner. That all will happen. But for me, the mega trend is that the Indian investor now, the average saver now, understands the importance of equity as an asset class and is ready to shift that asset allocation in favor of a productive asset class, where history has told us that if you remain invested in equity for a long period of time, you will always get the best returns.
So can this kind of show of support from the retail investor continue? Is it a long-lasting trend? Have we finally seen that paradigm shift where we were always bemoaning that participation in equity of the Aam Aadmi or the retail investor is limited? Has it really grown to that level where it makes a difference? Let me go across to Amisha Vora. She's joining us on the show today. She's joint MD of Prabhudas Lilladher, Sunil Subramaniam, MD and CEO of Sundaram Mutual, and Madan, Sabnavis, Chief Economist at Care Ratings. Welcome to all of you. Great to have you on the show. Amisha, let me start by getting your take on what we've seen in the markets today. And I know we're close to 60,000. It's just a number at this point, like age is just a number, because we'll cross it sooner or later. I know we've had a bull run for a while, but I want you to take the larger view of what we are seeing in Indian equity, and is this fueled, in your view, by retail participation?
So a couple of things I will highlight here, and one of the most important being that we are going to be a 5 trillion economy. And this next 2 trillion we will be adding in the shortest possible time. And globally, it is seen that then when 2 to 5 trillion or 3 to 5 trillion journey, when a country does, markets don't go up 20, 30, 40, 100, 200%. They really go up by 400, 600% or more. So I would say that while yes, the current bull run is part of the global liquidity, it's also part of the journey that we as a country are doing. Second most important thing at this juncture, where we think that maybe we have moved up a lot, our earnings CAGR for last 5 to 6 years is just about 3%. Next 3 years will be 20%. So this rally is also on the back of fundamentally strong growth, not only because of the demand growth or metals growth, also because our banks are reasonably cleaned up, so the provisioning requirement is going down. Last but not the least, the real estate part, I would like to say that, the real estate prices were depressed for almost 10 years. Now the equation has come to a point their affordability index is the lowest in the world at 3 times, which means from 3 years salary, an average person can buy a house in India. At a time when interest rate on housing loans are the lowest in decade or 2 decades. And with COVID, everybody has realized the value of 2 or 3 room apartment as we need more rooms. When residential real estate sector moves, the ripple impact on economy is so massive. So in nutshell, what I want to say is there can be corrections, there will be volatility on the way, but we are not done. There is more to come, and economy is also chugging along pretty well.
Yeah, so let me come back to the point I was making about the role of retail investors, because if you have to look beyond the story of where the index stands or where the Sensex stands and where the Nifty stands and how valuations of company have grown majorly, it's important, if you're looking at it from a wide angle lens, to see whether more Indians than before are taking advantage of this, whether they are getting the benefits of this bull run that we're seeing, or is it being limited to that small number of people as has typically happened so far. So let's just go across a bit of the data before I go to Sunil Subramaniam. Incremental DMAT accounts in million. So in FY18 we had 4.1, FY19 4 million incremental DMAT accounts, FY25. In FY21, post the pandemic, suddenly the story changes. You have 14.2 million DMAT accounts added on in that year. In FY22, only till August of this year, you've had 12 million DMAT accounts. So it's no secret that people want to come in and they want to participate. Sunil Subramaniam, are we seeing that growth in DMAT accounts at the cost of SIPs, at the cost of mutual fund participation? Or are these growing now hand in hand and Indian investors are coming in whichever way they find?
So let me, Tamanna, take you back a little bit in time, right? What we are seeing is a trend from an economic perspective. What do I mean by that? So we've seen a historic period of low interest rates. Okay, that's number one. Why do I point that out? The low interest rate regime combined with a low inflation regime, right? Now, you can say inflation feeds into interest rates, so both go together, is leading to financialization of savings. Why? Because historically, as Adish pointed out, Indians used to put their money in physical assets. I think Nikunj also referred to this, real estate and gold. But that, if you see the long-term trend, when inflation is high and interest rates are high, is when they shift to physical assets. And when you have low inflation, low interest rate, financialization of savings, a shift from physical assets to financial assets takes place. So it's the first move which is happening, that the charm of real estate to buy a house and charm of gold is losing sheen. That's one. The second thing I would point out is consumer surplus. Now, when I take consumer surplus, there are two types of surpluses I'm talking about. One is the financial surplus, because during the pandemic, right, incomes didn't come down for the middle and high income. Only the marginal workers, the migrants, they got affected. Salaries were there, increments were paid, and so people's incomes relatively were stable, but their expenses came down dramatically because of the lockdown and the pandemic. They didn't go and spend as much. So their consumer surpluses in money terms went up, number one. Number two is the time surplus. Because they were all working from home or operating through the internet and through all of that, they had enormous time on hand. And in this Google-driven age, they have enormous information on all asset classes and markets. So this time surplus plus financial surplus combined with this means that they had to invest in financial assets. Now I come to my final point, where there is the what I call as the TINA factor. When you come to financial assets, let's say a bank deposit. The traditional bulwark of Indian investment in financials was in bank deposits because it was guaranteed and the return was also guaranteed. Capital guarantee, return. But today, the fixed deposit rates, let's take 5.5%, and let's take the lowest income tax paying person. He's given a 20% tax, a 5.5 becomes minus 1.1, 4.4%. So the TINA factor means there is no alternative. When you are to go to financial savings and your alternative is giving you 4.4%, an equity market which even gives you single digit 8%, post-tax is still giving you 7.2. So you're talking about almost 75% more income from the equities market. Now, it doesn't take too much brains to figure out this math, and the young, smart, the demographic advantage. That is the number of youth in India who are taking first-time job, are smart, internet savvy, information is available at their fingertips. Do a quick search. So DMAT accounts and mutual funds, because even new folios for mutual funds have grown, SIP book has grown, and NFOs from mutual funds are collecting 5-figure, which was never the case even in the previous boom. So all of these factors put together means there's a fundamental shift in the Indian middle class's thought process on equities. And the final icing of the cake is the confidence they have got with the Modi regime. See, the first term of Modi was gone in preparation. The second term when COVID pandemic hit, and then you saw the markets rise. The confidence that this government is meaning business, doing everything, means the average investor has an undying faith in the power of the Indian economy to grow. So I think all of these factors emotionally have come into play, and that's why you're seeing this phenomenal increase in DEM account, phenomenal increase in mutual fund SIP book, which is touching 10,000 crores, and phenomenal increase in new fund offer participation. So I believe that this movement is here to stay, because after all of this, compared to the major emerging markets.
I'm absolutely thrilled, Sunil, about how you have, I am absolutely thrilled about how you have managed to merge this story and this discussion on the equity boom with the political environment and politics of the day. You've used a very specific term that we talk about when we're discussing elections and politics, which is TINA. There is no alternative. And look at the context. He is saying that there is pretty much no alternative. If you want to make a decent return on your savings, putting them in your savings account means you're losing money. FD means you're pretty much losing money. Real estate in terms of an investment has still not picked up. People might be buying to stay in, but not yet. Gold is okay, it's there somewhere or the other. So there is really no alternative. Madan, Sabnavis, you agree with that? It is that sort of mesh of circumstances which is leading to more and more people looking at equity as something which is acceptable. It is not the high risk, no, let's just put all our money in FD and gold situation anymore in many more Indian households.
I agree to a certain extent. I think it's a combination of factors. One is, I think the credit goes to RBI and the government for ensuring that interest rates have been compressed to such an extent that as individuals, you're so desperate And then comes in the greed factor. I go back to the Wall Street movie which said greed is good. Everybody is saying that you can make a lot of money on the stock market. It's totally irrational the way in which the Sensex is moving. Okay. Now, I think Amisha had mentioned something about a 5 trillion economy. We have been hearing it for so many years. See, 5 trillion is a number which is going to happen at some point of time. Now, even today, when you're looking at the growth which is taking place in the economy, it's quite pathetic. Even at 9-10%, if I compare over 1920, it's going to be 1 or 1.5% growth. So actually, the Indian economy is still in a slump phase. We're not really growing. We'll probably do so, I think, for 23, 24 onwards, when we may have a genuine number of 7 to 8%. But today, I think there is a lot of greed and there is lots of desperation. And I think that's what the fear which I have, Tamanna, because today when we're talking of 60,000 Sensex, if I enter the market at 60,000, thinking that the index is going to go up to 66,000, there's going to be a correction and it's going to lead to a lot of disillusionment. Okay, because when I'm talking of retail investors, I don't think they're that perspicacious. They really don't know what's happening. They just know that, look, stock market badra hai, let's all get into it. So I think that's what's really driving the entire thing. I agree that in the long term, as economists, if I draw a relationship between the economic fundamentals and the Sensex, I get a very good relationship. But if I look at it from last year onwards, I don't think anything has gone right in the Indian economy. We're just sort of recovering right now. And to think that in the recovery phase, I can move from 30,000 to 60,000, it's quite absurd. So I think it's only because of the TINA factor. I agree with Sunil fully, because thanks to the government, as I told you, the government keeps telling the banks, RBI tells the banks, transmission is not taking place, lower the interest rates. In fact, I don't want to get into another discussion of saying we've reduced the cost of borrowing to such an extent that we're making the system run into so much of risk. Today, I get a house loan at 6.5, 6.75%, which is again absurd. Okay, so I think we're running into another problem there. But to answer your question, I think it is fairly irrational and the stock market is exaggerated. Okay, a certain amount of upward movement is justified. But if I look at it, like you started off this discussion by saying that, okay, there's Evergrande, there is the Wall Street. Now, see, what the Federal Reserve does, you can interpret it two ways. One, you say that the quantitative easing going to stop, there'll be fewer funds. The second thing is to say, oh, well, world economy is growing, so therefore we are also going to grow, so let's all ride the wave. So it can be interpreted both ways. So I'm very suspicious of this. And my major fear, I think Sunil is dealing a lot with individual money. At some point of time, there's going to be disillusionment. And then you see what's going to happen. We've had this phase. I remember I was 30 years younger, I think, when we had this scam
no,
of...
I'm glad you're saying that. No, I'm glad you're saying that, Madan, because we need to temper, we need to get all angles, and we need to temper the exuberance that we're seeing as well, because this has to be sustainable. This has to be a point at which you shouldn't have a situation where newer entrants into the market then get their fingers burned and then sit it out for another decade. You don't want that happening. Let me just try and get you to elaborate a bit more, Madan, when you link it to what is happening in the economy today, where real growth at the end of this financial year will maybe be 1.5% over pre-pandemic because of the kind of hit we saw. We are still recovering from a pandemic. There is no doubt about it. The future looks bright, hopefully, but there could be a third wave. There are uncertainties and we have a long way to go. Do you think that the markets today are not in sync with what the actual situation is in the economy?
They are definitely not in sync with the actual state. But I think when I talk to people who know stocks better than me, because I'm an economist, they normally say that we're looking at the future, we're seeing the discounted earnings, which are, we think that the corporate results are good, they're going to continue to be good when the economy does well. And I think that's what Nikunjan mentioned, saying that if you wait for a long-term period, but what is a long-term period? Nobody defines saying is long-term 10 years, 20 years, 20 years, I may not be alive also. Because if I look at my own investments, which I made in mutual funds, Sunil, this will be information for you. I've been actively investing the last 15 years. When I look at all my schemes, if I go back to before pre-pandemic time, I haven't gotten a return of more than 8%. And everybody talks of 12%, 15% is what you get in equities. So it all depends upon the time period you're talking of. So a person who enters at 60,000 today, they probably have to wait for 80,000 to actually get that 8% return. And we really don't know when that will happen. In between, there could be lots of fall. There could be a crash in the Sensex, in which case a person would panic. And we have seen the herd mentality. The moment it comes on, lots of people will start running away from the market. So I think when we talk of long term, as I say, I think Keynes or somebody said that in long term, all of a sudden, nobody really knows what's short term, medium term, long term. We use these terms very, very loosely.
Amisha, I want you to respond to some of the points that Madan Sabnavis has made. He's saying, yes, the TINA factor works, which is why retail investors today are looking around and saying, why don't we also hop onto this bandwagon? Why is it important that retail investors come and they stay? They don't have a situation where, again, they are burned, they buy in at very high levels and then don't know where to exit.
Two important factors I would like to highlight. One is on the retail investors, but one is still back to fundamentals. And that is relating to the COVID, the resultant digitization, and because of which the rising deals or order book for our IT sector. So when we say that, yes, economy is still not to our 19 levels, but when economy was growing at 6 to 7%, for almost 3 years, markets were flat. So there were reasons that not only banks were getting cleaned up, NCLT was getting set, but the corporate India was getting a new message in terms of an ILFS or in terms of a jet or in terms of a divan housing. While all that was happening, index was pretty flat. So index or the markets are one segment or one asset class which do not move very linearly. It goes in a bout and it covers all the distance, maybe in a shorter term, rests a bit. So coming back, I would like to say that when they say in US, which is one of the most advanced countries, the retail industry is having complete consumer fulfillment on digital medium to the extent of only, that means digitization penetration is only 18%. So rest of them have to yet to completely digitize. And this is retail, so is banking. And when Indian IT does well, large part of population gets new jobs, they start spending, and that's where also to some extent our hopes are pinned for a growth in the economy. Now, there would be many factors, including geopolitical, including interest rate rise, or including a bad monsoon, which can temper the momentum, no doubt. But two things are clear, that GDP growth rate will keep growing up. It is not going to slow down, and markets finally sometime do catch up with that. So maybe it will consolidate for a while, but direction cannot change for medium term. When I say medium terms, it's 3 to 5 years. Coming to the retail investor participation, one important thing is a number of new accounts are opened by millennials. Yes. Millennials are listening to YouTube influencers. They're reading about the companies. They go to Stockage and find out the presentation of the company. So they are not just uneducated class who just go by something. So yes, 40% of the other new entrants would be just going by hearsay. Millennials are reading and taking their calls, entering and exit also.
You made a very interesting point. Sunil Subramaniam, I'm sure you want to come in because this is very different points of view we are getting. And it's not just one trend that we're seeing on this debate. So I'm sure you want to come in. But I want to spur you on with this thought. A new class of investors is emerging who are not looking at it with the kind of fear that maybe your typical middle class householders were looking at when they put their money in markets. You now have people who are very comfortable using their phones to trade, whether it's in equity or it's in cryptocurrency or it's in something else. They're not too invested in this and they're doing it as a learning process. They're getting their information also from newer places. And that new kind of investor may be smaller in number right now, but as they grow in number will also define how the markets move.
No, undoubtedly. And I tend to agree with Madan here that the retail investor is an emotional being toggling between fear and greed. And if the sustained correction for, let's say, a week, 10 days, then they could panic. But I want to temper that with the quality. And that's where I draw on your point, Tamanna, is that they used to say in the stock market that when your shoe shine boy is talking stocks, this is the time to sell. Because that was a day of the Harshad Mehta days where people would go based on rumors saying, ye chal raha hai, usme dalo. Today's investor is overloaded with information. He is highly educated. I'm not saying he's not emotional, but he is able to understand, and I expect him to be significantly more mature than the older retail investor of, say, 2006-7, which was a typical middle-class employee who just put into equity markets because of rumors and tips. So I argue that we have a much more evolved young middle class, millennials, as Adesh said, who are well read, who have knowledge at the tip of a tongue, tip of their buttons, and will, I will assume, look at the riskiness, and when it risks, I will expect significant amount of people to actually buy an average to go away. But I'm not denying that the retail investor is not, those which are not guided by advice, right, are going to be emotional. And investment is an emotional decision. For all the calculation you do, ultimately there is an emotional decision. But my point I'm trying to say is, as long as you have a good picture of the future, and that's where I bring my point back to Mr. Modi. What has he given us? He has given a kind of self-belief to the Indian person that India can grow, can thrive, and do that. That Indian thing, and it comes from the Olympic sports to cricket field to everywhere. The new India is a confident Indian. It's not even 2006-7 when we were like, very passive people. Today there's a new aggression, a new forthrightness, and that will come that belief in the future. And to then answer Madan's point, that the actual EPS growth, actual economic growth, and the Sensex move are not correlated. The point is the market always has an eye on the future, right? Buy on the rumor, sell on the fact. It's like buy on the expectation and sell on the reality. So it's always the future. And as long as 1 year from now, 2 years from now, the future outlook of India continues to be bright, there will be people buying. So it doesn't matter if the reality doesn't catch up with the expectation, as well as the new expectation is on a higher trend. So I would say that arguably, as a country, thanks to our demographic dividend, thanks to the fact that family planning did not work. So for till 2050, Tamanna, this is an important factor. Till 2050, India's working age population is going to rise, whereas from 2017, China's working age population started declining. So you look at that, and the other factor with Rajesh pointed out about a cusp, right? $2,000 per capita income is also a cusp. You take Singapore, Korea, Taiwan, all these nations. When they cross $2,000 per capita income, the next 3 to 4 years, they saw them shooting to $10,000 over a decade. So we are at that kind of a tipping point as a country where I think that we ourselves can't imagine the brightness of our future. There will be shocks in the middle, but I think the long-term blue sky picture of India is one of a decade of growth, high single-digit growth, which is what I think is feeding into this optimism.
Okay. Okay, so is it the decade of growth? Is it the political narrative? Is it? I mean, it's an interesting parallel that Sunil Subramaniam draws. That an enthusiastic India, enthused even by our wins at the Olympics, wants to invest in the markets. I mean, I don't know. I tend to believe that people want to invest in the markets because they want to make money. Their politics might sometimes not gel with what is happening, the kind of narrative that Sunil is talking about, but they still want to make money. Everyone wants to make money no matter what their politics are, let me put it that way. But Madan, the question about, how the demographic dividend is going to play into this story and how crucial that is. Talk to us about why it's important to have a wide-based equity markets to reflect the growth of an economy.
I think, Tamanna, what's more important is that people need to understand the market. And contrary to what Amisha is saying, I don't really think the millennials are that smart. Everybody is being influenced by the influencers. So I watch your channel every day. I have it on the whole day. And you have lots of these gurus coming in saying, buy now, sell now, buy now. And I just say that, okay, this guy is a good person. His person makes lots of sense. So therefore, I'm going to invest in it. I don't know how financially literate are people to really understand what balance sheets are, what P&L is, to even understand this. Even today, Tamanna, and I think at Economist, we keep blabbering a lot in lots of these seminars. Lots of people think the Indian economy is doing great at 10, 11%. They think that we're actually doing 11%. And it comes as a revelation when I tell them, look, it's only 1.5%. If I compare with 18, 19, it's even lower than that. Okay, so I don't know how financially literate people are. And today, when you're talking of demographic dividend, I think it's actually a horror story which we have, because we're not creating enough jobs. And again, we create low-level jobs. People who are working in malls or maybe your Swiggy boys and all that, and who are seeing these kind of things. I mean, if Amisha and Sunil have their sway and people say, look, these people say the economy is doing well, the government is doing well, let's start investing out here. I think it all goes back to saying that in the absence of alternatives, and what you had said, I think more with it, everybody wants to make quick money. So I think that's what's really driving the market. I'm not saying the fact that the economy will not grow. Definitely the economy will grow, but I think the stock market is very much exaggerated in terms of its movement. I think if you had moved from 30 to 35,000, I would have said that's a fair enough from the time the pandemic set and we started getting the vaccine, etc. But jumping to 60,000 looks a bit irrational to me.
Well, I think the quote of the day is millennials are not all that smart. So we'll stick with that. But while the party is on, why not enjoy? And that is what we are seeing right now. It is a party in the market. Thank you everyone so much for joining us on this discussion. We'll take a very short break at this time.